Welcome class, this video is going to run through exercise 14.2 in your textbook, which is where we're going to create an allowance for a doubtful debt. I encourage you to work through this with me, and you'll find the question in your textbook on page 286 and in your workbook on page 249. It's a relatively quick question which is asking us to create an allowance for doubtful debts. So let's just have a quick look at the question, explain what an allowance for doubtful debts is as some revision, and then let's do the recording of this exercise. So who are we in this business? We are Sullivan's Shoes, and it is owned and operated by Brooke Sullivan, and she has provided some really important information for the year up to 31 May. We have cash sales for the year of 63,000. Credit sales for the year of 25,000, sales returns of 2,500, and importantly, they've given us balance of accounts receivable, and I want you to cross that out purely because that is not in your textbook. So we are just looking at the three bits of information: cash sales for the year, credit sales for the year, and sales returns for the year. Number A, part A of this question, is asking us to prepare the general journal entry to create an allowance for doubtful debts equal to 2.5% of net credit sales. What does this mean? This question is asking us to acknowledge that we have done credit sales for the year, and we need to understand that 2.5% of them is predicted to not be paid back. We need to make an allowance for doubtful debts that is going to do a number of things. We are going to reduce our assets and increase our expenses to record an allowance for doubtful debt and a bad debt expense. But what is the number that we're going to go? We need to find net credit sales. And the net credit sales here is our credit sales for the year, so 25,000. Importantly, 25,500. And importantly, we're going to subtract the sales returns because they are all from accounts receivable. So that means we have not had net credit sales of 25,500. 25,000 has been returned to us. So our net credit sales for the year are 23,000. How much of this is not going to be paid back? 2.5%. So 23,000 times 2.5% equals the grand total of $575. So this means that our business is making a prediction that $575 of their net credit sales for the year are going to not be paid back. So we need to make a recording in our general journal to record this. So what is the date that we're going to record? The date is 31 May. And then we're going to record a bad debt expense as a debit, and I'll explain why it's a debit in a second so we're all fully clear. Bad debt expense of 575, and then an allowance for doubtful debts. Now this is an annoying one, it's long, but don't abbreviate it. If you don't have enough space, make sure that it's clear what you're trying to do outside, but make sure that you do it in full words, and that is 575. And importantly, it doesn't say to not do a narration, so let's do the narration. This might be a relatively long one. We're going to say this is an adjusting entry, because we are adjusting some of our accounts. Why is this an adjusting entry? Because we're creating. So we're going to create an allowance for doubtful debt. And it's important here to make it clear that you recording how much this is. So we're making an adjusting entry to create an allowance of doubtful debts of 2.5% of credit sales. So this is a really long narration, probably the longest narration you're going to do. Importantly, we're going to write that this has come from Memo 87. So we have now done our general journal entry. What does this mean? If we think about this, we have created a bad debt expense. So this is an expense that has increased. Expenses increasing are debits. And we have reduced our assets. So this, in a sense, is a negative asset account that has reduced our assets. Reducing our assets is a credit. So we have recorded an expense because this is an outflow of economic benefit, not receiving these sales. And we're also recognizing that our assets aren't as great as we once thought because not all of it is going to come back. General journal entry done. We then need to prepare the balance sheet. Accounts receivable, as you know, are a current asset. But we need to now recognize that not all of our accounts receivable is going to come back to us. So we're going to write our accounts receivable which is $23,000 because we don't subtract the $575 off the total. We actually acknowledge that this is less allowance for doubtful debt. Of $575, which means our net assets is $22,425. And then we are done. We have recorded in our balance sheet that our accounts receivable is $22,425. We've recorded an expense that would go into the other expenses of our income statement, and we've creatively and successfully, faithfully represented, remember we're doing this to faithfully represent our accounts, faithfully represented that not all of our credit sales are going to come back as cash within the credit terms. And that's how we create an allowance for doubtful debts. I will now, in a future video, do 14.4, which shows how we actually write off a bad debt when it occurs. Keep practicing.